Hey everyone, and welcome to this explainer. Today, we're unpacking the hidden mechanics of financial traps. We're going to contrast the agonizingly slow bleed of traditional stock market traps with the explosive, literally overnight wipeouts of modern meme coins. Because as you'll see, whether you're looking at a legacy company or a brand new digital token, the underlying DNA of a trap is surprisingly similar.
So let's kick things off with an absolutely crucial question that every focused learner and investor has got to ask themselves. How do you know if an asset is actually a hidden gem trading at a massive discount, or if you are walking right into a trap? Honestly, it's the ultimate test of your analytical skills.
All right, part one, traditional stock value traps, the slow bleed.
Let's start in familiar territory. What looks like a deeply discounted business is often just a sinking ship. According to veteran analysts, or honestly, anyone who's spent enough time in the value investing community, a trap occurs when the market is totally correct in pricing a business's decline. You're going to see the red flags: stagnant revenue, zero innovation, and a completely shrinking competitive moat. And watch out for the illusion of action too. Management might buy back shares just to look busy, completely ignoring that their core industry is dying.
There's this brilliant piece of wisdom from the value investing community that hits the nail on the head. Management loves to downplay issues on their earnings calls, right? But as one user noted, if you spot one fundamental flaw, like one cockroach in the kitchen, you can bet your life there's a whole colony hiding right under the fridge.
To sum up the ultimate fate of a traditional value trap, just because a stock's valuation is historically cheap doesn't mean it won't just keep dropping. As another investor pointed out, the trajectory is pretty simple. Cheap, go cheaper, go bankrupt. A low-priced earnings ratio is definitely not a life raft for terrible fundamentals.
Okay, so here is the critical pivot for us today. While a traditional stock market trap is like a sinking ship taking on water slowly over years, the modern meme coin trap operates entirely differently. It's way more like a rigged casino, or a rocket launching without a parachute. The time frame completely shrinks, from years down to mere days.
Which brings us to part two. The meme coin illusion, rockets without parachutes. This is the hyperspeed equivalent of the value trap, where fundamentals like revenue are just completely abandoned for unregulated hype. Get this, 623,000%. Take the Asteroid Shiba token, or Asteroid. It pumped a staggering 623,000% in a single month, hitting a market cap of nearly $155 million. And the foundation for this? Literally a rumor about a plushy toy named Asteroid on a SpaceX flight. No protocol, no utility, no formal team, just a viral narrative driving an insane surge. Another wild example launched in January 2025, the Trump token. This really brilliantly illustrates a new evolution of the meme coin: political branding meeting pure financial speculation. As documented in a recent academic case study, this token leveraged a highly loyal supporter base and ideological branding to drive incredible, completely fundamentals-free demand right around Inauguration Day. But man, that meme illusion shatters so fast. Driven by extreme FOMO, the coin rapidly surged past $70, only to just plummet below $30 in a matter of days. That sharp, immediate correction totally traps late buyers at the absolute peak, leaving them with massive losses the second the hype cools down.
Moving on to part three, mechanics of the trap, centralization and control.
So how are these explosive wipeouts happening so consistently? Are they just natural market corrections, or is the whole game rigged? Well, the secret usually lies in extreme centralization. Research into that Trump token showed that 80% of the total supply at launch was controlled by just two affiliated insider entities. Only 20% was public. This massive concentration completely contradicts the whole decentralized ethos of crypto, giving insiders total control over both the price and the liquidity. And it gets worse. The trap isn't just in the token price, it's baked right into the underlying fees. The token structure explicitly facilitated the extraction of roughly $100 million in trading fees within just its first 2 weeks. The creators explicitly stated they'd receive trading revenue, meaning they were heavily enriched by the transaction volume itself, totally regardless of whether the retail traders won or lost on the coin's actual price. So the crucial takeaway here is that this rigged structure creates a massive, rapid wealth transfer. Within the first 48 hours of trading, just 21 heavily capitalized whale traders secured over $214 million in profit. Meanwhile, the late-arriving retail investors were left holding the bag. One trader reportedly lost $5 million in just 2 days.
It's an entire system practically designed to benefit the insiders and those early whales.
But honestly, beyond the concentrated ownership and the whale manipulation, the absolute most dangerous trap is often hiding right in the code itself. This is where the actual smart contract is structurally weaponized against the buyer.
Jumping back to that Asteroid token for a second, security auditors at Go Plus flagged some super severe warnings right in the token's smart contract. They revealed that the anonymous creator retained the absolute unilateral power to disable all sales. Think about that. They could lock your funds so you literally can't sell. They could also print infinite new tokens to dilute the supply to zero, and they could secretly change transaction fees to confiscatory levels.
These built-in structural trapdoors make meme coins the absolute perfect vehicle for what's called a rug pull. That's a fraudulent maneuver where developers abruptly vanish with all the exchange liquidity, instantly rendering the token completely worthless. When a creator holds the keys to disable selling or mint infinite tokens, you aren't just fighting regular market volatility like you do with stocks, you're literally fighting code that was designed for you to lose.
So as we wrap up this explainer, I want to leave you with one genuinely critical question. Whether you're analyzing a slowly decaying traditional stock or the flashing lights of a highly centralized meme coin, are you genuinely investing in value, or are you just providing exit liquidity for the insiders? Keep that front of mind to avoid the trap today. But as AI and automated trading keep evolving, you really have to wonder, what will the next generation of financial traps look like? Stay curious, everyone, and thanks for joining me today.